Now, the ammo that we have, the next card we have to unleash, and we know this is coming, is the SLR relief. So the SLR, this is coming out of the post 2008 international banking and capital reforms. The SLR is an extra capital surcharge that countries are asked to levy against their GSIBs, right? So it's like, all right, of all the banks in your country, you have to pick the top uh, that you deem a globally systemically important bank, and you have to make sure that they are safer than safe, right? Because if those too big to fail, well, by definition, if they fail, then the thing that's too big will also fail, which is your your financial system, which is funding the sovereign. So these kind of packs, this accord, the Basel III, they layer on this extra SLR. I want to say it's a 1.5% extra capital charge, which is balance sheet capacity that has to sit in reserves that's not allowed to go into credit. What the SLR exemption would do would free up balance sheet capacity from the largest banks in the US, like the domestic financial system, and allow them to buy more treasuries. So that's your break glass if you're the Fed, the Treasury, et cetera, and you're watching this closely. If we have to pull that card, we will, and that should create a new buyer for Treasury debt across the board, but that should bring uh, rates in. I don't think it's a long-term solution. I think the private sector, uh, households and businesses are the ones who actually matter here in this environment. Ultimately, you're going to have to get them to buy the sovereign debt. And so, with that kind of background in mind, I think this SLR exemption would be a temporary measure, but it could get us off of this pinch we're in. I mean, we already described the fiscal situation as quite a pickle, but being at the bottom of your trend, if you're watching your asset, you're susceptible here and you want to get off the ropes as soon as possible, get saved by the bell and make it to the next round. So that's what I'd be watching for on treasury debt.